Let's talk market fundamentals, asset allocations, which way global fund managers are leaning right now with Binay Chandgothia, portfolio manager with Principal Global Investors, who joins us live from Hong Kong. Binay, good to have you back on ET Now. Thank you for joining us. It's been a lukewarm start to 2014. Do you think we could be in a range till the outcome of election, or Indian markets before election could give a nice big surprise?
Well, you've had a good rally in the Indian markets in the last few months, driven partly by expectations on elections. You could have a further run-up in that count if the election trends are perceived to be towards a single party coming, a change coming at the center. But if not, then you could probably have a situation where the markets could be sideways for the next few months before the election results come out.
Binay, the FII flows still remain very, very muted. On an average, we're just about seeing 40 to 50 million odd dollars. And the exuberance, even though, technically we're almost close to an all-time high, the exuberance from the market is completely amiss. What's keeping the FII investor back? And is it the political uncertainty which is only emerging in the run-up to the elections?
Yeah, political uncertainty is one part of the equation, but by and large, if you look at the global asset allocation flows, you're still seeing probably better momentum in the developed world as compared to the emerging world. You're seeing better growth upticks for US, Europe, Japan at the margin, whereas most of the emerging world is still kind of struggling through with growth concerns about China, about the monetary policy over there, and of course with the monetary environment in the whole EM world, which is, you look at Brazil, you look at India, maybe they're close to the end of the cycle, monetary tightening cycle, but the conditions are still not there for allocation shift to happen to emerging world from the developed world.
Binay, so is this uncertainty more like an opportunity? 2011 and 12, everyone was convinced about emerging market doing well, but developed markets have done well. Right now, the consensus towards developed markets is strong, but do you think developing markets could do well?
My sense is the second half would be much better for developing markets as compared to developed markets, partly on three counts. One, as I said earlier, emerging markets could be closer to the end of their monetary tightening cycle by the second half of this year, which will lay a positive backdrop. Developed market growth is likely to pick up in the first 2 quarters of this year, which implies that the export beta, if it comes through, will support emerging market growth. The third is you're seeing adjustments from the emerging market side and the bottom-up side as well, with companies not expanding as aggressively as they were, realizing the new normal for growth. And all three combinations, given the fact that the currencies in the EM world have also weakened. Like going into last year, 2013, the currencies were looking fairly overvalued when you look at the real exchange rates, for most of the emerging markets. They have corrected quite a fair bit, so that should provide an additional tailwind to emerging markets. So my sense is you could see a reversal of some of these flows into the second half of this year towards emerging if it gets cheaper.
Binay, just this morning we've seen the China flash PMI data, which is disappointed. What does it mean for markets like India, wherein at least the metal sector is so sensitively correlated to whatever happens in China?
Well, China is clearly pursuing two objectives. One is that they are following a much tighter monetary policy regime than a lot of other markets in the world because they have this big problem about too much of debt being accumulated there. So Chinese monetary conditions are going to remain fairly tight according to us. The implication for that is that domestic demand conditions in China will remain soften. They're also kind of on this path to fighting corruption, to kind of curtailing excess spending by government officials. And that also leads to a situation where domestic demand is going to remain a little weak, So clearly the Chinese growth integer, to my mind, is going to go down. To what extent it goes down from about 7.5%? We think it probably goes down to 7.25%, not below that. That should still provide a robust enough, growth outlook for economies which are directly related to China in terms of supplying goods into China. India is largely an importer from China. So maybe, domestic growth going down in China, inflation coming off in China might actually help India because the cost of imports into India will come down a bit. But, India's cycle, again, by and large, given the fact that it's essentially a domestic-oriented economy, will depend more on domestic factors than what happens in China.
Binay, last time when we interacted with you, I distinctly remember you had a more neutral stand on India. So you were not bullish, but you were not bearish. Are you still maintaining that stand, or are you looking at allocating more capital to India on a relative basis?
Well, I would think the stance is still the same for India. Last time, the reason why we were not kind of underweight was because the valuations look fairly cheap, At this stage, valuations have run up, and there's this big election-oriented uncertainty which is kind of looking at us. So my sense is as things get clear after the elections in terms of the policy statements of the new government, in terms of the interactions between the various aspects of government policy, you probably look at a positive stance. The good thing, though, between last time and this time is that at a bottom level, you're seeing some traction in terms of better earnings visibility, probably at a situation where the margin contraction, which was evidenced for 4 to 5 quarters in a row, is kind of ebbing now, and you probably see some little bit of margin expansion as well. So still neutral, but waiting for the right time, I guess, to increase allocations.
Time to wait for the outcome of election, because if the outcome of election is strong or favorable, by that time markets would have already run up.
Well, that's a clear risk, as in election-oriented uncertainty is always a risk. But the view today is that given the fact that the markets have run up in the last few months, maybe the markets are kind of over-expecting a positive outcome. Maybe it comes, maybe it doesn't come. So it's better to kind of remain on the fences. And I'm sure, based on what comes out, there will be enough choice available to investors to make the right calls and
let me just
alpha.
So let me just quickly challenge your thesis. If you think that markets are pricing in a verdict, if I look at the sectors which are doing well right now, are exporters, pharma, IT, pharma. They've got nothing to do with election.
Yeah, it's a general feel because people are in a way hedging their bets on India. As in, you don't want to go underweight into the election cycle, but at the same time you want to buy stocks where you see positive bottom-up, feel, as in you see decent earnings growth, you see earnings momentum, you see companies coming out and beating expectations. They're still not ready, I think, to dip their toes into sectors where the macro is still weak, but the macro could change dramatically if the election outcome is very positive.
So, Binay, what's the sense that you're getting about the defensives? Because, while you are seeing moves in bits and starts from other names like Capcodes, metals, etc., do clear favorites within the equity market segment continue to be IT as well as pharma. So, do you think IT as well as pharma across the sectors continue to remain buy on dips?
Well, they have delivered strong earnings growth. They don't have the concerns that the markets have had in India over the past 2 years, which is they're not levered. They're obviously companies which are debt-free. Cash flow generation is pretty strong. Dividend payouts are strong. The markets have bought that theme. Maybe some of that, weakened in the last quarter where you saw a bit of rally in some of the cyclicals, some of the kind of weak quality names. But I mean, my approach towards, say, portfolio construction in India would be to have enough mix of these stocks because they deliver earnings growth. The management quality is now strong, and they've had a kind of pretty successful run in navigating through the difficult times. At the other hand, you look for opportunities in the other cyclical sectors when they get too cheap or when your macro outlook changes to be a little more positive.
What about the absolute ugly ducklings of Indian markets? Metals, some PSU names. I can talk about, PSU utilities. Are you a buyer there?
Well, ugly ducklings is some of the metal companies have done pretty well actually in the last 3 or 4 months, driven partly by the fact that the terms of trade improved, with the currencies weakening so much. So there was a kind of a move up in some of those names. So you would look to play those when the valuations are very cheap and they're kind of forecasting distress. In terms of PSU names, you got to pick your battles. We don't like PSU banks because we think there is going to be an NPL overhang which is going to last at least for the rest of this year. But there could be other names, for example, in the energy sector, where you could find decent opportunities to invest when the sector gets sold off.
PSUs of late as well, Binay, have gathered a lot of interest. Anything that you like from that space, or is it going to be a completely avoid because of the government intervention?
I mean, our strategy is clearly stock picking, so we are not bracketing PSUs as one sector. As I said, PSU banks is something we don't like. We prefer private sector banks over PSU banks because of the fact that they're delivering much better in terms of earnings. And we worried about the NPL ratio issue for PSU banks. Sectorally, wherever you see good opportunities and where the market price is, justifying an investment into the company, we would go and do that, irrespective of whether it's a PSU or a private sector company.
Binay, I spoke to the CEO of Aberdeen Asset Management about 2 days ago, and he told me something which sort of had stayed with me, and which is that for global investors who've invested in India in last 30 years, they've not made money because whatever gains we've made, currency has actually eaten into those gains, and now investors are panicking. Are you getting a sense with your clients as well?
No, not really. I mean, we haven't seen too much of a worry on that count. Clearly, currency has been a big negative, but the good thing about economies which allow currencies to adjust is that it presents good investment opportunities after currency is depreciated. Now, you look at the Indian currency, Indian rupee is it seems like a little undervalued when it comes to real effective exchange rate. And typically when you get into markets using that as a benchmark, you tend to be not shocked at the currency depreciation taking away your returns. So it's not such a bad time, I guess, to look at India on a unhedged currency basis.
Top 3 holdings. You can tell me a bit about your declared portfolio. I'm not getting into why you buy them, but I just want the names.
Well, I can't disclose that because the portfolio team, the team that does the portfolio, again, India is part of a global allocation, so it's very hard for me to segregate which is the top 3 in India.
What is your current asset allocation to India, again on a relative basis and versus the MSCI index?
I think we're broadly neutral.
And you would no plans to make that neutral overweight?
Well, as I said, it depends upon how things shape up. We are essentially bottom-up stock pickers. So whenever opportunities present in India relative to other markets, it will automatically cause us to be overweight India. Or whenever there is a significant downward drift in terms of, the macro showing significant improvements, then you would do the same thing.
Binay, good speaking with you. Really appreciate you taking the time out and speaking with us today.